taking the time to join us today and meet with NEXERA Energy Corp. Mr. Shelby Beatty, CEO with us, and Mike Rice, CFO, are joining us today to do a presentation. Just a quick intro. One, for the record, I am a significant shareholder. I've bought over the last few weeks, including more today at 5 cents. Probably about 8% of the company now. So I'm very, very excited about the future of what this company represents. But I like to be transparent. I am and have been accumulating shares for the last several months. One, I think oil and the forecast I see from BMO, Fitch, the major players, all forecasting $90, $100 oil out till 226. So obviously we're in a very bullish market. Obviously the high price represents significantly stronger potential for profits for any company, be it junior or senior. I've gotten to know Mike and Shelby quite well over the last year. A couple of things the company had to do, I believe, to turn this successful, to turn this into a successful company. I believe the company is on their way. One, quickly, was debt. They basically got rid of the debt. They moved that into a royalty structure at very, very favorable terms to the company. So that's great. Two, the company owns a ton of equipment, which means they can drill effectively and a lot cheaper than a lot of other companies that have to either use NEXERA's equipment and or use or buy their own equipment. A company basically has generating a little bit of revenue, a couple $1 million or so, has been continuously drilling and has had great success drilling because they've been taking interest as opposed to getting paid for the equipment and renting or that normal scenario. The company now is basically utilizing their services and operations, equipment and so on, but is actually taking interest in the wells. I think it's a great model because it's cost effective, doesn't cost them anything, and they basically go out, drill, and they get paid an annuity for the life of that well. The next step would be to continue to do that, but also for the company now to start drilling their own wells. So in a nutshell, the stock was 2-3 cents. Now been trading around 5. Volumes picked up on average a bit better. Company's obviously moving towards profitability. I'm very excited about what the company offers investors. I love 5-cent plays, being a micro cap guy, but I think on the last note, I'll hand this over to Shelby, our CEO. As I've gotten to know Mike and Shelby, again, we bet on the jockey, and at least I do. I bet on the jockey, not the horse. And getting to know them, and it's been actually, I hate to say this, but a pleasure getting to know both Shelby and you, Mike. It really has been. It's been fun, and I've learned a lot about the oil industry. But most importantly, I learned people who are cost effective, know how to run a company, and obviously know their business. And lastly, know the area. I think Shelby's been in Texas 30 years or something. I mean, these guys know the area. They know where to drill, what to do. So I think it's a good foundation that for high-risk investors at 5 cents, I think it's a great play. So again, I'm in pretty deep. And on that note, Shelby, I'll hand it over to you, CEO. Thank you for your time, and Mike for your time to join us. Shelby's going to run through a fairly quick presentation, and then we can open it up to question and answers. And Shelby, I'll hand it over to you.
Thank you, Neil. I don't know if you will put up any type of a presentation on the screen if you'd just like me to talk, but I'll just kind of launch into just a brief overview of NEXERA and what we have going on down here in South Texas. And if you can see the screen behind me, you're looking at the Gulf Coast region of Texas, where you have the state of Texas producing about 50% of the oil and gas, or at least oil in the United States. So we're in a very good area. We're in 5 counties: Wilson County, Guadalupe County, Atascosa, Medina, and Duval counties in South Texas. Good operating counties, good services available, good access to pipelines and to trucking to get the oil to market. But as Neil mentioned, 2022 has kind of been a transitional year for us. Focus has been clean up our balance sheet, which we are in the process of completing at this point in time, eliminate all of our long-term debt, and then our production operations. So if you look at each of our core areas in those 5 counties, we've increased our production across those core areas. Even with one of our rigs being down, we've had Mike just sent me a message, said you're able to see the slideshow. So even though I can't see it, I guess you can. So if I jump ahead, we can, circle back. But in each of those core areas that we have in South Texas, we've been able to increase our production in 2022 and reduce our operating costs. So we thought we could have done a little bit better in 2022 just because we had both rigs we thought were operating, but we had to rebuild rig 2, which is a service rig. So that took us a little bit longer to get it back up and running, but we are now and feel pretty good about what 2023 will bring. Anyway, so as we prioritize our drilling projects for 2023, that took us into a focus, what we call a re-entry focus. And so we have looked at primarily Guadalupe County and Wilson County in that regard. And the other thing we had to focus on in 2022 is tighten up our investor relations, which led us to hire and bring in Neil and Investor Cube. And so we can kind of tighten up our message and be more consistent with our communications, which will help us considerably. But I don't see the presentation. I don't know if I'm jumping ahead or not, but anyway, I'll still continue to launch into it. So if you look what we focused on, it was the re-entries. We identified an 8.3 mile stretch of a fault that we felt was underdeveloped. You'll see that 2 wells that were developed on this that actually hit the fault that produced 108 and 215,000 barrels respectively. So what we've been focusing on is geophysical and geology between those 2 wells to identify some wells that were drilled vertically. And what we plan to do is mill windows, set silica plugs, and drill out and go to the fault that was missed. So some may have missed the fault. And the way faults run in this area is that if you don't hit the fault, you don't have production. We are chasing fractured porosity, not primary porosity. So what we look for are the faults in the fracture systems. And once we can connect to those, then we can get our production. So that's what we've been primarily focused on. And we have a pretty good plan put together. We've actually had a third party verify our plan for these re-entries, and again, feel pretty good about it. Access to services should be fairly good, especially for what we are doing. We don't need any large rigs. As a matter of fact, some of these re-entries we're going to be able to do with service rigs. And it still gives us that ability to do that.
I'm sorry, so, Shelby, one question. Yeah. You talk about re-entry. Is that a higher success rate? I mean, is this a better way to go in the sense that, as opposed to drilling a new well under, I guess, I'm not, there is terminology, but is that a higher potential success rate to get production faster, more cost effectively than going a more traditional route of, I guess, just drilling a well?
Yeah, because what you've got initially is most of the wells out here were drilled vertically. So what we're doing is we're not drilling another vertical well in hopes that we will miss the fault or hit the fault. What we're doing is entering a vertical well bore, and then we are drilling to the fault. So let's call it a short radius horizontal. So we don't have to worry, because these wells, you cannot just, let's say you miss the fault by 20 or 30 feet. And you think, well, that's okay. I'll put a frac job on it and we'll frac out to the fault and still establish production. You can't do that because your frac will just go perpendicular to the fault. So you won't be able to hit the fault. We've tried it, and many have, and many have failed. So what we are going to do then is mill the window and then drill to the fault horizontal. Short radius horizontals. We don't expect to drill more than 200 or 300 feet in a horizontal well to hit our faults. So we think it's a pretty solid plan. Again, also the cost to drill a new well with surface casing and steel is outrageous. Getting access to rigs. When you talk to somebody who has a rig and they'll go to work for EOG for 6 months or come to work for us for a week, they'll go to EOG every day. So this type of operation, being able to do it with a service rig, being able to have access to services and the reentries, we believe is a pretty solid plan. And that's what will set us apart. And we hope to have production rates very similar to what you get in a new well anyway. So anyway, that's kind of an overview of the play itself and what we plan to do. But reentries, we think, are the answer for us in the near term.
All right, maybe Shelby, because I've got the presentation in front of me, maybe I could ask you a few questions. You've talked about the type of wells you want to drill. We've talked about obviously getting rid of the debt off the balance sheet. We've talked about it obviously being cost effective, higher chance of success. What, just maybe get into us, because obviously, you know, we all, like, you know, I always quote Wayne Gretzky, you know, I did great because you don't go where the puck is, you go where the puck is going to be. So what would be what would you like to see, Mike and Shelby? What would you guys want to accomplish this year? In terms of obviously you're looking for increased production, but can you give perspective on kind of how many wells you'd like to drill, or any perspective on kind of what are we looking at in terms of revenue growth and I guess production expansion for 2023 and going forward?
Well, it'll be a two-pronged approach too. We can, we'll work on our existing production with our current service rigs that we have. See, we have, with the equipment that we own ourselves, we have the ability just to maintain and increase our production on the existing wells that we have through the 5 counties. We do have to go outside and hire services that we don't have. For example, we don't have the ability to frack. We don't cement wells or that type, and we can't drill deeper. So we have to go out and hire that equipment. So we look at increasing production on our side, but also on the new wells and the reentries, easily double to triple our production from what we currently have. So I think what 2022, we had about 2.2 million in revenue, and net revenue to the bottom line about 300,000. So we could easily double or triple that, but at least 6 re-entry wells. And we'll do them 3 at a time. We'll start in Q2 and do 3 wells, and Q3 do 3 wells. And then we'll just progress from there and just start acquiring our lands. See, what allows us is that small companies like us, we don't need a large land position, but we have over 100 drilling locations ourselves in our inventory right now. So it's not that we lack.
Go on.
It's not that we
Please
lack
go.
drilling locations. We're just trying to, let's put it, high grade some of those locations initially, and that'll be those first 6 to 9 wells that we'll drill.
And what like in the 2.2 revenue, what, like, do you have an idea of like what was the average oil price that you were seeing last year? That you're selling this oil for? I mean, they're talking 90.
I would say
I saw BMO has like a $90 target, I think, for this year. So like what would your average sell price be last year?
I would say, Mike, that it would be in that probably 67 to 75 range would be average. What we get down here is we get West Texas Intermediate minus $2 because we're South Texas, so it can be a little sour. So they do have some deduct over West Texas Intermediate. So we get West Texas in minus $2.
So you're getting $60. I think oil right now is what the OPEC just made the big cut again because OPEC wants the price up, which is good, right? But so we could be looking at also maybe a 10, 20, or maybe higher sale price in 23. I'm just saying if you double, triple the production and you grab the extra 10, 20% in the price, it really starts to make a difference.
Changes everything. Absolutely.
All right. So and I'm sorry, I didn't ask this, but Shelby, maybe just quickly tell us a little bit about yourself, because I've gotten to know you pretty well. You've been, I mean, he looks good, but he's about 300 years old, Shelby. I'm sorry, he's been in Texas about 300 years, but maybe just tell us a bit about yourself, because you've been doing this forever. You've been living there forever. I mean, it's important that you know your shit. Like, pardon my French, you know your stuff.
Right. I've been down here since 81. I'm 67 years old, although in oil years, that's like 87. So you do have to add something to that. But I'm primarily South Texas too. So started down here as a landman, acquiring mineral rights, and then was able to see every phase of a play, from the land acquisition, the geophysical, the seismic acquisition, the geological review, putting a play together, and then going out and finding the services to get the job done. So it's a project manager where I oversaw the drilling, everything, the completions. So this was back in the 80s when you really didn't have a lot of service companies. I think when we did our initial frac jobs, we had Dowell, and we had Schlumberger, and you had Halliburton. So you had 3 companies to choose from to go complete your well. And I think Halliburton, we fracked our first 200 wells with Halliburton because that's who you had. So the market's changed so differently, and you'll see behind me, you'll see the different trends from the Frio, and then up above me here, you'll see the Eagle Ford that happened. And then up above that, you'll see all of the Austin Chalk and Buddha and Anacacho that was developed. All of this it's amazing. All of this has happened over the last 30, 40 years. So yes, was there a lot of production prior to that? Yes, but the changing in technology, horizontal drilling and fracking and all of those things changed our industry significantly. And I was lucky enough to be a part of that, to watch it happen.
So you have an inventory up to drill up to 100 wells. So you made a comment before though, because you drill the well, you hit the well, the infrastructure is in place to get the oil to market. I mean, you pipe it, you truck it, like what, or does it guess, I guess, varies by area? Like, just explain to me how that works.
We truck it. We sell primarily, we only sell to one company. We've had issues in the past down here and also up in Canada with your purchaser maybe getting over leveraged and going bankrupt on you. So we stay with one purchaser right now, and that's Shell. So we sell all of our production to Shell.
And they'll buy everything. So whether it's 20 million or 10 million or what, like they'll basically buy whatever you give them.
Yes, and we truck everything. We don't pipeline, so we truck. So with Shell, we have 5 companies that do our transport for us. So if we don't have trucks, it can be an issue. You may have one trucking company that their drivers are out of hours one month, so you may have to switch and go to another. But we have 5 companies that do our trucking for us to Shell facilities. But yeah, we primarily sell to Shell.
So that's good, because I'm pretty sure, I haven't checked Shell recently, but I think they're pretty big, I heard. So I think so. Yeah. And how does it work? Just so I know, you kind of said like it's basically like spot less $2 kind of thing. Is that?
Yeah, we get the West Texas Intermediate -$2. We get a little bit for trucking. If they come in and a load has more than 1% basic sediment and water, that load can be rejected. You may, but that's very, very seldom. If we call in 20 loads or 50 loads, we may get 1 rejection in 50 loads. So that's not very common at all. So, but in our lease roads, we can always usually get in and out. Like today, I think we've taken in almost 3 to 4 inches of rain here in Wilson County and Guadalupe County. And there's probably only a handful of leases that we will not be able to get in and get our oil out.
Okay, so the weather isn't particularly incumbent to the opportunity to build a business. Right. So I on the last note, and then Mike, I think maybe Mr. Rice, you could say a couple words, because Mike is and Shelby have gotten to know quite well, and Mike also again knows the stuff well. He's the Calgary man, but he's pretty regularly down in Texas with Shelby. But so just so I get an idea here, you're doing about 2.2 million now, right? You could drill, let's say, 9 wells at least this year potentially. I mean, obviously, if we had a higher market cap and a lot more money, we could accelerate that plan, I'm assuming, but we don't want the dilution. And I know we've already talked about this at these levels. So the idea would be drill minimum 9 wells, hopefully potentially double or triple that revenue. What kind of margin would we be looking at if we did 8 million this year? Are we making $2 million? I mean, like, what kind of EBITDA might we potentially see? Because your costs are pretty low. I know that your burn's pretty low.
Yeah, no. So let me jump in here for a sec, Neil. Yeah, I mean, what we're forecasting on a 6-well re-entry program where we risk that so that 4 of the wells are successful, 6 are not, or 2 are not, and we have production risked as well and declining. We've got a decline curve set on this, and we show revenue just north of $5 million from those wells in those first 6 wells in the first year, with our costs are not going to increase dramatically, so we will net from that north of $3 million. So that's what we're talking about here. We've never had the opportunity in the past few years to be able to go out and do higher impact wells like this on our own, because we had a structure of debt with our lender, who's a very he's made a very big step here in taking the approach that he's willing to have faith in what we've got proposed to do here in South Texas, and what we're ready to go drill. And he's stepping away from his debt, taking it off our books. He's agreed to accept a royalty in lieu of ever getting paid back that debt through debt payments. We're not hindered by having any restrictions on us. So yeah, no, Neil, with 6-well reentry drilling program in Q2 and Q4 of this year, we will see over the next 12 months north of $5 million of revenue and north of $3 million in net profit.
Okay, that's very good. Now, just a comment, when you and I, and I spoke to a bunch of advisors, we got a lot of interest from Research Capital, Scotia, RBC, a lot of guys like the play, especially because again, fundamentally started a lot of this just because people are so bullish on oil. But I do know, because the catalyst, guys, just so everybody knows, was I'm not buying this thing because of the debt. So Mike and Shelby have worked diligently, and the support, I believe, from the debt holder has been amazing, because he's been really supportive and believes in what these guys are doing. But the royalty thing's pretty good, right? Like under a certain level, like you don't pay him at all, and basically, what is it? As oil goes up, you pay him more, but it goes down, you pay him less. And I think there's a threshold of, say, 60 or something. Can you just comment on that? Because it seemed to be a pretty good deal. It actually seemed to be work much better in your favor than the debtor's favor. But yeah, can you just maybe comment on that?
You're right, Neil. I mean, we started off with 2 loans, one to our wholly owned subsidiary Production Resources, and one to our predecessor Emerald Bay Energy, Texas, of $4 and $5 million plus as the principal. So a total loan balance of just right around $14 million. He capped that at $10 million structure where there's no royalty. It is a gross overriding royalty, so it comes off the top. So it really doesn't affect our bottom line, because it would be built into any model that I'm talking to you about as far as how how it's paid out. It's just like as if he would be the lessor of the play. And so yes, if oil's $150 a barrel, maybe we can pay as high as a 20% royalty, but that's just a huge win for both sides. But it will be a sliding scale. There'll be ranges. At $50 to $70 a barrel, it'll be a certain percentage. $70, $90 a barrel will be a certain percentage, but it will not impact our profitability at the end of the day, because it's coming off the top line as essentially a division of interest in the property itself. And we've factored that into all of our cash flow projections going forward, Neil. So yeah, it's a win-win for us. It's with our lender, and it took some outside of the box thinking. Nobody's in talking to several accountants, we've had several accountants involved in coming up with this. Nobody's kind of seen this kind of a structure, because no lender would typically ever do something like this, Neil. And yeah, I would like to thank Neil actually for kind of spurring us along to getting, coming up with some way to resolve this with our lender. If we wouldn't have spent 5-6 months looking for ways to raise capital to go drill these wells, we probably wouldn't be here where we are, right, Neil? So yeah, thanks for spurring us to action to get this done. And I think it's just a huge opportunity for all of us, and for our shareholders, and for potentially new shareholders as well.
All right. And Mike, while you're still on the phone, maybe you can just comment, because we're going to wrap it up. There are some questions here, which Jan or I can ask. But Mike, maybe just comment, just go over market cap, shares outstanding, warrants, options, that kind of stuff. Like, just give us that overview.
Sure.
On the cap table.
Yeah, we got
Please.
62, as most of you know or may not know. We did a consolidation several, just right at the start of COVID, actually, and we currently have 62,434,000 shares outstanding. The structure of that those shares are about 35 to 40 million are insiders, and well-known friendly shareholders. So the float, I guess, that we out there would be the balance of that. And yeah, what other questions, Neil, about that would you like me to answer?
Let me just, Jan, do you want to ask a couple of questions?
Yeah, we got a couple of questions emailed to us, and if there's any questions from the audience, please feel free to send it in the chat. So if I see you've gotten rid of the debt, can you explain or comment on how the royalty payments work?
Yeah, so it comes right off the top, and so we would, and it's price dependent, so we would actually have to calculate that manually every month. We would get our run statement from Shell for the barrels sold. We would determine what the price is that month because it is price sensitive, and I don't know if we made that perfectly clear. And we are actually working with our lender right now on finalizing what those percentages are going to be. And so the best way to explain it is, for example, at $80 a barrel, which is kind of where we are right now, it would likely be 10% of the gross revenue of the company through our oil and gas sales. So that's probably the easiest way to explain that at this point. The final details will be worked out here in the coming weeks as we put together the definitive agreement, and we will, of course, disclose those when that's finalized.
Perfect. This question's probably for Shelby. In the areas you intend to drill into, either you will own or participate in, can you give me an idea of what average daily oil production is?
Say that one more time. Give me
So
the,
Shelby, what he's saying, Shelby, is like, you know the 5 counties, you're drilling in a couple. We're just trying to get an idea, like if you drill 6 wells, like there's got to be, we're not holding you to this, but like what is like an average well in the areas that you're looking to drill? Let's say these 6 wells, next 9 wells, what, like, is it 50 barrels a day, 500 barrels a day? What kind of guesstimate, like what kind of averages are in the area?
it almost, because you're going after fracture porosity or faults, is that it's kind of, you look at the cumulative. And so they may come in at 50 to 150. And what we're really after is the cumulative. So we're after that 100,000 barrels to the 215,000 barrels. And that may come over 5 years. It may come in 3 years. But I think, Mike, what did we put? I think
Well,
we were fairly conservative in how we did that.
Yeah, and working with our geophysicist and our geologist, we capped. What we did is to risk these wells and to create a decline curve, we actually show initial production rates of approximately 150 barrels a day per well for 4 successful wells, and then we decline them from there.
Okay, so those are pretty good numbers. So I see how you can double or triple revenue. So you drill the 6-9, you get to 10 million. Hopefully we see a market cap that starts to better reflect the company's success, right? And then the idea would be because again, no one wants to suffer dilution, but now and I'm not speculating that this would be in any way where the price could be. This is my own thoughts. The dreamland people, investors I live in, that we got to 15 cents, 12, 15, 20, then we go and raise what? Another 3 million, drill another 6, 7 wells, and put up 30, 40 cents and so on. And basically, I guess, raise money in conjunction with dilution, market cap, to build this out to get revenues to say potentially 10, 20, 30 million. Is that kind of the plan?
That is the plan. That's exactly how we get to a point where we're drilling through in our own cash flow. But to get there, we're going to have to do exactly what you're saying, Neil, and that is the plan. Yeah.
Okay. Jan, have any other questions?
No, we've covered all the questions that have been asked.
All right. I had a few emailed to me, but guys, I will send those to you afterwards, or a couple of them are actually technical. So I'll forward that to you, Mike and Shelby. So just to summarize, first, again, we want to thank everybody for their time today to meet Shelby and Mike. We typically are going to talk about doing quarterly webinars now. Shelby, I just want to say a thank you because I asked Shelby because they focus so strongly on being internally getting their ducks in a row. The company has not spent any money nor time getting out to investors, getting out to advisors, portfolio managers, etc., which is one of the reasons Investor Cube has been brought in to assist Mike and Shelby and NEXERA with. So I asked Mike earlier, when's the last webinar he's done? And it was basically, I haven't. So that being said, I think we can all agree, did a great job. So thank you, Shelby. Mike and I guess we talk a lot already, so it's not so bad, but Shelby did do a great job. Thank you very much for taking the time and educating us on the potential. Obviously, we're available. Any questions, anybody wants to talk to Shelby or Mike, we're around, so we're happy to set up a call one-on-one if anybody would like that. And if not, I just want to again thank you, Mike, of course, as always, Shelby, for your time, and everybody for being on the call today.
Thanks, everyone.
Thank you, Neil.
And thank you, guys. Have a great day.
Thank you, everyone.
Ciao.